Hello, everybody. We are on lecture number 32. Number 32. We're getting towards the end, aren't we? Okay. Let's go ahead. I got a pretty full class today, I think. There's a lot I'd like to accomplish. So let's go ahead and dive in. I think the first thing that I want to do is go over exercise 9.2, because I don't believe we covered that, did we? Okay. So let's go ahead and do that one so it doesn't get put off any longer. Exercise 9.2, page 378 in your book. Beecham Company recorded the following selected transactions during November of 2009. And it gives you about 5 entries there. Okay. Next page. Open a GL account having T accounts for AR, sales returns, and allowances. Also open an accounts receivable subsidiary ledger having a T account for each customer. Post these accounts to both the GL and to the accounts receivable ledger. Okay, now this is getting to that principle that we had discussed as far as every time you make a debit or a credit to AR, you have to make it to the control account, but you also have to go over to the subsidiary detail, correct? Because the total of the subsidiary detail always needs to equal the total that's in your control account. Remember when we discussed that? Okay. So, let's do number 1, 2, and then we'll number 1 first, and then we'll talk about requirement number 2. Okay. Now, I'm going to show you what the T accounts look like. You can check your answers here. It's on 2 separate pages, so we'll have to look at them in turn. Okay. That's the T accounts for the control AR. This is the control AR, the sales, and the sales returns and allowances. Now, I think we've talked about this before, but whenever you're posting to the T accounts, I think the best way to do it is to go line by line, okay? So post a debit of 5817 to the control AR and to the customer AR for Ski Shop. Then go post a credit to sales. Then go post a 1774 debit to the control AR and to the AR for Welcome Enterprises in the detail, and work down it line by line. If you try to do all the sales at once and then do all the ARs at once, inevitably you'll forget one. Okay? So I encourage you guys to move line by line. Let me put that back up there, and you can check. Okay? Any questions, and I'll show you the next accounts here in a second, but any questions on AR, sales returns, and allowances? And actually, let's just do this. Let's just add that this is the control AR. That's the AR that will appear on the balance sheet, the total, the 12061. Okay? Anna. Oh, you don't need to put the dates on there. You don't need to put the dates on there. Okay? You know, we don't do a whole lot of posting to T accounts in this class. Do you know why? You know why we don't do that?
Because you don't really do it.
Well, yeah, you guys, I think, have the idea. If you create the correct journal entry, usually whatever accounting software you have is going to be doing the posting for you to the T accounts. You see what I'm saying? Now, you got to come up with a JE. But once you enter the JE, it posts it automatically. Okay? But I do like to every now and then do it, because I know you guys have a good time doing it, if nothing else. Let me show you what the accounts receivable ledger looks like, or this is sometimes called the subsidiary detail. Now, we only had 3 customers here, but in a real life situation, we could have hundreds, if not thousands, of customers, right? The key is that the ending balance when they are all summed up for all your customers, need to equal that total in your control account. Correct? Okay, questions there? Okay, one thing it asks you to do in requirement number 2, and I don't think I actually talked about this, was they talked about doing a schedule of accounts receivable, correct? Now the schedule of accounts receivable is just a listing of what each customer owes you at a specific date, and then you tie that to your control account at that same date, okay? Talked about this in your book. If you do a schedule of AR at November 30 of 2009 for this company, you just take the ending balance of each one of your customer accounts, there's only 3 in this case, and that total needs to equal the total in your control account, which it does. Okay, so that's called a schedule of accounts receivable. All right? I don't think that's too difficult, is it? Makes sense? And can you see where an accounts payable situation is going to be very similar? Where you could have a schedule of accounts payable and what you owe each vendor, and that needs to add up to the total of your control AP. Now this chapter is not on AP, but we'll go ahead and bring that up now anyways. Okay? Cool? All right, let's move on to the next thing then, if there's no questions about that. Okay? Let's go over the homework I assigned. That was the handout. Okay? I think I gave you 2 of them to do, did I not? I think I gave you Ibram Company and Fezzik's Place Company, is that correct? All right, so let's take a look at that. Go ahead and dig that out if you can. Okay. Now, I will guarantee you that you'll have something like this on the test, okay? Some students just never really understand how to do these journal entries for estimating bad debt expense under the allowance methods, okay? So make sure that you understand how to do it, okay? All right. Are those the numbers? I've changed this exercise a couple of times. Double check real quick those main numbers. Is that the same numbers you have on your handout? Yeah? Okay. All right, let's take a look. In 2005, Ibram Company had total sales of $12.57 million. It was known that this amount included $4.89 of cash sales, with the remaining amount being credit sales. Okay? Okay, and we can figure out what credit sales would be pretty quick, right? We'll do that eventually. In addition, the unadjusted trial balance for Ibram included the following items. AR had a $785,000 debit balance. Allowance for doubtful accounts had a $4,800 debit balance. And accumulated depreciation had a $15,800 credit balance. Do we even need that? Do we even need that amount, that accumulated depreciation? No. Every now and then I like to throw something in there, just so you'll know what we don't need as well as what we need. Prepare the adjusting entry for Ibram to recognize bad debts under each of the following independent assumptions. Okay, situation A, an analysis suggests 6% of total AR will be uncollectible. Okay? Now, as soon as you see that percentage of AR, you know that's the situation where we have to do that extra little step. Okay? So let's go ahead and do that. Let's go ahead and do that. Okay? All right. So we know that 6% times our AR amount is, how much is AR? $785,000? What does that equal? $47,100. Now, is that the amount that goes in the journal entry? No, 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 it isn't. What we have to do is a T account, okay, for allowance, for doubtful accounts. Now, we have a beginning balance in our allowance doubtful accounts of $4,800, not on the credit side, but on the debit side. Is that correct? This amount that we just computed is what we want to be the ending balance. Okay? So the question is what do we have to do to this account to bring a debit 4,800 to the desired ending balance of a 47,100 credit? We have to credit it for how much? 51,900, is that correct? So our journal entry to estimate bad debt expense will be, no, what are you doing, Krug? I almost made the mistake myself, didn't I? It is for 51,900. Okay, a little messy, I apologize. But there is the entry, okay? A debit to bad debt expense for 51,900 and a credit to allowance for doubtful accounts for 51,900, okay? All right, any questions on that? Sorry, that was a little messy. Okay, if not, let's go ahead and do B, which says that 1% of credit sales is what our bad debt will be estimated at, okay? Well, all right, we know that our total sales, are $12,570,000, correct? And we know that our cash sales are $4,890,000, correct? Thus, we want to know our credit sales. Our credit sales are $7,680,000, okay? Now, the percentage of sales method, sometimes it'll be percentage of total sales, sometimes it'll be percentage of credit sales. Credit sales being those sales that were on credit and where there's a receivable involved, okay? So that's the first step that we have to do. Now, if we take that times the desired 1%, gosh, I'm writing really messy today, aren't I? What does that equal? I believe it equals 76,800, does it not? Now, for any sort of percentage of sales method, whether it's a percentage of total sales or a percentage of credit sales, boom, that can go straight to the journal entry, can't it? So that is our journal entry to estimate bad debt expense under the percentage of sales method. Did you get that? Okay. Questions on Ebram Company? Anybody? All right. All right. Let's take a look at the next one. The next one was Fezzik's Place, is that correct? Okay. Once again, take a look real quick. Is that the numbers you guys had on your handout? Is that numbers you had? Yeah. Okay. Okay. What's the amount of credit sales for this company? Once again, they give us total sales. They tell us how much were cash sales. We can back into the amount that was credit sales. And that equals $6,170,000. doesn't it? Okay? Okay. Now prepare the adjusting entry for Fezzik's Place to recognize bad debts under each of the following independent assumptions. Okay? The first one is we use the percentage of AR method with an estimate of 7% of AR as uncollectible. Okay? All right. Well, $7 times our accounts receivable, which is 1,357 million, equals what? Let me do that in my head. I think it's 94,990. Is that what you get if you do it on a calculator? Okay. Now, is that the amount that goes in our journal entry? No. We have to do our T account, right? Let me zoom in a little bit. Okay. This is our allowance. What's the beginning balance of our allowance for doubtful accounts? 35,680. Is that correct? We want that 94,990 to be the ending balance. Correct? So we need to know what we have to do to bring the beginning balance to the desired ending balance. Say what? Is it? Is it really?
Yeah. So that, yeah, it's different.
Let me see your hand out. Doggone it. I changed it. It's all right. No biggie. Okay. Let's change it. Thank you for pointing that out. Okay. It's all right. 7% times 1.357 million equals, that still equals 94,990, correct? Now let's take a look. Let's do a different allowance account. We can do it a little larger. Okay, what you're saying is that the 35,680 is on the credit side. Is that correct? And we want our ending balance to be 94,990, right? So what do we have to do to bring that beginning balance to the desired ending balance? What's that amount? 59310? 59310 it is. So, if we back this out, whoops, wrong way, then our journal entry to estimate bad debt expense our journal entry will be as follows. Okay, is that what you all got? Are we good now? Did you get that, Anna? Morgan? Zach, is that what you got, buddy? Okay. Okay, cool. All right, let's do the other two methods. Ignore this. This was wrong. Okay. Okay, bad debts are estimated to be 2% of credit sales. What's 2% of 6.17 million? What is it? 1, 2, 3, 400?
Yeah.
Okay. There she is. Okay. What if instead bad debts are estimated to be 1.5% of total sales? What's 1.5% times total sales at 8.95 million up there? 134,250. Again, under the allowance method, the journal entry is always a debit to bad debt expense and a credit to allowance for doubtful accounts. These are just different methods for coming up with the number that goes in that entry. With the percentage of sales method, we don't have to do that little T account, do we? So there's the journal entry. Is that correct? All right.
How is the less percentage more money?
Total sales.
Yeah.
Oh, of
Total
total
sales
sales.
is
I
more.
didn't see that. Okay, sorry.
All right. Number 3. Show how AR and the allowance for doubtful accounts appear on the 12/31/05 balance sheet given the facts in Part 2A. Okay, this is a little refresher. Allowance for doubtful account. Allowance for doubtful account is what? What type of account? It's a contra asset. Thus, it has a debit or normal credit balance account. It's a normal credit balance account. It's deducted from the asset, okay? So, let's take a look at that. Okay. Let's do it down here. Let me back out a little. Okay, so what this will look like is on the balance sheet, we will have accounts receivable. What's our accounts receivable? It tells us $1,357,000 less the allowance for doubtful accounts, correct? Let me zoom in a little. And how much is that? That ending balance is 94990, correct? Now somebody will have to tell me this number. And so the net AR, what is it?
1,262,010.
1,262,010?
Yeah.
Can I get an amen from the congregation? Anybody else get that number? Somebody double check that number. Not that I don't trust you, Lauren. Huh?
Yep.
You got it. Okay. But I just want to have confirmation. So that is how that would look. You could put that around there if you wanted. But that is how that would look on the balance sheet. Now, I usually like to ask that on a test because one of my philosophies of accounting is if you don't know how something appears on the financial statements, you don't have a full understanding of that concept. Okay? Okay, that was kind of a harder one, wasn't it? Kind of a harder one. Okay? With these problems, what's the best way to study for my tests? Redo the homework. Not look over the homework. Redo the homework. Get a blank piece of paper out. See if you can do these again, okay? All right, what I want to do now, is there any questions? What I want to do now is I want to do a couple in class. So what I want to do is cut away to that snazzy, jazzy JCCC music for you folks at home. And you do the same thing that we're going to do here. But I want to do Quick Study 9.3 and Quick Study 9.4. Quick Study 9.3 and Quick Study 9.4 just for a little additional practice on these concepts. Okay? So let's cut away and let's work on that. And I will talk to you in a few. Quick Study 9.3, Quick Study 9.4. All right. All right, let's take a look at that. Let's do a quick study 9.3, quick study 9.4. If you did exercise 9.3 and 9.4, you're probably confused at this point. We were doing quick study 9.3 and 9.4. Okay, I'm not going to read through it because you just read through it, but let's buzz up to the answer and take a look. The entry that you should have made to estimate bad debt expense under the percentage of receivable method is that entry right there. And you can see I did the little T account analysis there to the right. Okay? Is that what you all got? Okay. Okay, any questions on that? Now, part 2, it says, what would your entry have been if instead of what it told you, the allowance account had an unadjusted debit balance of $150? Well, how much would your entry be then in that case? How much? $1,575, wouldn't it? So that's part B, or part 2, I should say. Okay? Okay, so any questions on quick study 9.3? We good?
So we didn't have to do a journal entry?
You didn't have to do it. You could have done it.
Where'd the $150 come from?
Well, that's in part 2 they said, what if we didn't have a credit balance and allowance for doubtful accounts of $550 and instead we had a debit balance of $150 on the debit side?
Oh, I totally skipped that on accident.
You did? Well, Lauren, just another example of you being a slacker.
I know,
I'm
right?
just kidding. Okay. All right, let's do quick study 9.4. I'm not going to read through that. Let's just take a look at the answer. Don't have to do any T account analysis on the percentage of sales. Calculate your number, boom. That's what number goes in the journal entry, correct? Boom, there she is, okay? All right, questions? Okay, good deal. All right, let's go back to lecture. I want to talk about something else here. Now, do you remember when we talked about about when we account for bad debt, there are 2 methods, right? There's the direct write-off method and there's the allowance methods, and that's what we've been working with today, correct? Now, the direct write-off method, going back to that slide real quick, looked like this. Look at the screen. Okay, remember that? That was the direct write-off method. Okay, now coming off the PowerPoint back to me, we said that the direct write-off method violates the matching principle, correct? Because the expense of writing off that bad debt is not going to be in the same period as the revenue it helped create, correct? Well, and thus we went on to say then that the direct write-off method doesn't follow generally accepted accounting principles, which is true. Now, there's one point I want to tell you though, however. You are allowed to use the direct write-off method and be in conformance with GAAP if your financial statements are not materially affected by your bad debt expense. Okay? In other words, if using the direct write-off method is a really small part of your financial statements in a whole, in essence, if they're not material, if it's not a material situation, you can use the direct write-off method and still be in conformance with GAAP. Okay? I don't like to tell you that all before. I like to tell it actually after. So does this make sense? Direct write-off method, not in conformance with GAAP, but you are okay to use it if it's not a material situation. Cool? Okay. When you're studying for your test, though, and if you read your textbook, I've had students before that say, well, wait, I'm looking at the book and it's doing it a different way than what you told us in class when we did that handout. Well, you're probably on the pages where it's talking about the direct write-off method, okay? So you got to make sure that in the textbook, are you on the section where it's talking about the direct write-off method, or are you in the section where it's talking about the allowance methods, okay? The allowance methods use the allowance for doubtful accounts account. You with me? Okay. Let's jump ahead a little bit. We learned about the percentage of AR method, correct? I want to talk about the second kind of percentage of AR method, and that is the aging of accounts receivable method. Now, before come back off the slide again. Let me ask you something real quick. Let's say I had 3 customers here, okay, and each one of you three guys owed my company a couple $1,000s, okay? Your account is current. That transaction was only like a couple weeks ago. Your receivable is 30 days since this time of sale, so it's aged 30 days. Your amount that you owe me, Brett, is 120 days old, and you still haven't paid. Now, all else being equal, which of these do you think has the higher probability of not being collected? This guy right here, right? The older a receivable gets, the less likelihood there is of collecting the cash on it. You with me? Okay? That's why collections people, they don't want to wait until the last minute when these things are 6 months old to start calling people and saying, hey, you owe us money. They want to do it at 45 days or maybe even earlier. Okay? So, the percentage of AR method, its philosophy says, well, we're not just going to take a percentage of AR. It really depends on how old those AR amounts are. So what we do is we look at an aging schedule. Okay? Now you can go to the slides, please. We look at an aging schedule. So we don't simply take a percentage times the AR. Whoops, sorry. We don't just take a percentage times the AR. We want to know how old each category is. And in this column, we're going to estimate the percentage that we believe will be uncollectible. Obviously, this stuff that is over 90 days old, we're going to estimate a high amount as uncollectible. 60% of that 3,100, which equals 1,860. For the stuff that's not even due, we're going to use a low percentage estimate of uncollectible, only 1%. But then you add that up. Let me get my pointer going here. You add that up, and this is the amount that you want in your ending balance of AR. Now, you still have to go through this T account analysis, knowing that this is your desired ending balance from using the aging of accounts receivable method, and that this is the beginning balance. What do we have to do to bring the beginning balance to the desired ending balance? It's all the same. The only difference is we're not just taking 1% times the total AR. We're breaking it down into aging categories and analyzing it in that way. And your aging schedule of AR as a manager of a business is something that's pretty important for you to look at. Know who owes you money, how old are these accounts, okay? All right, I want to talk about something real important. We have about 5 or 6 more minutes. Now, we have talked about estimating bad debt under the allowance method, correct? That's a debit to bad debt expense, a credit to allowance. We are still under the allowance method here. But now we're going to talk about when we write off a specific account. Okay? What do we do when we write off a specific account under the allowance method? Well, let's take a look at the PowerPoints. Let's say that we determined we're under the allowance method, but we determine that Morton, his $300 amount that he owes us is uncollectible. The journal entry under the allowance method is a debit to allowance for doubtful accounts and a credit to accounts receivable for $300. See, now we can credit AR. Now we know we're going to have to go to the customer subsidiary detail, right? But now at this point, this is different than estimating bad debt expense. This is when we have determined that yes, we know a specific account is not collectible. You with me? And this is what we do. Notice, we do not debit bad debt expense here, do we? Why not? Because we've already debited bad debt expense back when we did our estimate. Does this make sense? Now, this is something that's sometimes confusing for students. Let me show you this little handwritten thing here. And I want you to note it. These are both under the allowance method. If I ask you to estimate bad debt expense, this is the journal entry. Debit to bad debt expense, credit to allowance for doubtful account. If I ask you to write off a specific account, then this is the entry. I'll tell you what happens on a test. I'll ask you on a question to write off a specific account under the allowance for doubtful accounts. And people think I'm asking for this. I'm not asking you to estimate bad debt expense. I'm asking you to write off a specific account. Make a big note of that. This is always something that students kind of mess up. You with me? Okay? Note the difference between the journal entries under the allowance method. If I'm asking you to estimate bad debt expense versus if I am asking you to write off a specific account. Okay? All right, I got to cut back to the PowerPoints. I'll put that back up at the end of the class for you, face-to-facers, if you need it. Okay, now what happens if all of a sudden this guy walks in and wants to pay his account? Well, we'll take his money even though we've written it off under the allowance method. All we do in this entry here is we reverse what we just did, and then we show the cash collection like normal. Okay? So you make those two entries under the allowance method if somebody decides to, in fact, pay the account. Does that make sense? We won't even tell them we wrote it off. You with me? Okay, now as a summary, the percentage of sales method has more of an income statement focus because sales are obviously on the income statement, whereas the percentage of receivables methods have more of a balance sheet focus. And you can kind of read about that in your books. Okay? I think that's all we're going to do today. So let me give you your homework that I want you to do. Okay. What I want you to do is the following. I want you to read page 372 and 373. This is on the ratio, okay? Let me just write this out, and then I'll put it over on the overhead, okay? Okay, here's what I want you to do for homework, okay? I want you to read pages 372 and 373. I want you to do Quick Study 9.2, that's on writing off an account. Then I want you to do 9.3 and 9.4 exercises. And then I want you to do exercise 9.13, which will be a question over your reading. All righty? One last thing I should tell everybody. Your next test, and for you people at home, I will email you and provide you information that's more specific. But the next test is not just over 8 and 9. It's actually over 8, 9, and a little bit of 10. Okay? A little bit of 10. So we have at least 2 more lectures before we're done with the material in this section. Probably 3. I'll give you more information as we go along. Okay? But I want to kind of give you an idea where we are. All right? See you guys. Good class period.